A lesson to those of you who are out in the audience and might someday have the opportunity to be asked to do something like this. It almost sounds like behavioral finance. When you get asked to do something 6 months into the future, your forecasts of how costly it's going to be are always too low compared to what it looks like when it's 3 days ahead of you. I confess, when I saw Cliff 3 days ago and he said, "Hey Bill, how you doing? You getting ready?" I said, "Well, Cliff, if you knew what I had between now and then, you know, sleep may be the thing that the category that loses out." But in any case, I appreciate your interest in being here. I noticed the title in the program was Time Series Econometrics. And what I decided to do was to not have it be completely specialized in time series. In particular, what I want to do today is use a paper that Michelle Lowry and Micah Officer and I published in the Journal of Finance a couple of years ago as an illustration of how to use econometrics, both cross-sectional and time series, together to try and solve an economic problem that you're interested in. Some of the tricks, techniques, methods we used are somewhat novel, and I thought they provided sort of a useful case study for the advice I like to give our PhD students, which is a good research problem is one where the question is something you find interesting, and you then go find whatever the technique or method is that's the most appropriate for providing the answer to that question, as opposed to taking the hardware store approach where you go to the hardware store and you buy some tools, you know, a hammer and a saw and a wrench and so forth, and say, okay, I've got all these tools, now what do I do with them? You know, it's hard to build a good house if you don't know what a house looks like, but you've got all the tools. So that's kind of the goal of the talk today. I'm not specifically, even though the paper's about initial public offerings, I'm really not going to focus on initial public offerings except as a motivation for the statistical techniques we used in analyzing it. So what was the question we were interested in? Probably the easiest way to focus on the question we were interested in is to look at this simple little histogram. And what this shows in the dark blue bars are the bins holding the proportion of initial returns to initial public offerings. And what's an initial return? It's the difference between the price you pay if you're lucky enough to get allocated shares in an initial public offering compared to the price 21 trading days later, so a month later. So it's a 1 month return, if you will, from buying the stock in the initial public offering, selling it in the secondary market a month later. And if you look at this histogram, a couple of things come out. You'll see that the average for this sample of almost 9,000 initial public offerings is 22%. So the average underpricing is 22%. I don't, unfortunately, have my laser pointer with me, but there's a bin there that says 20%. And one of the things you'll see in that bin is that's not even the highest bar. 22% is a description of the central tendency of the average, but the other thing you'll notice, without too much imagination, is that the variance is huge. The standard deviation across these 8,000 transactions is 55%. So, you know, if you had a normal distribution with a mean of 20% and a standard deviation of 50%, you know, what's the 95% confidence interval? It's someplace between 120% and minus 80%. Well, that covers pretty much, you know, lots of stuff. So what do you conclude from looking at this? Well, a lot of the literature on initial public offerings has focused on the fact that on average there's underpricing. And no doubt, I mean, there is underpricing. And there's many, many papers that address the theoretical questions about why there's underpricing and various sorts of information asymmetries. But fundamentally, the biggest information asymmetry I think that we see, because almost all of these are firm commitment underwritten offerings, is that neither the issuing firm nor the investment banker that's working with them is very good at forecasting what the average aftermarket price is going to be. And so if you put the question that way, this notion that these are forecast errors, and they're biased, in other words, the average forecast error is positive, but that's not the biggest thing about it. The biggest thing about it is they're huge in terms of variability. I mean, the precision with which either the issuing firm or the investment banker can accurately forecast what the secondary market trading price is going to be a month from now after the IPO is horrible. I mean, that's a nice word, pretty strong adjective and adverb. And so the question we had was, okay, can we explain this inaccuracy in the forecast, this information asymmetry? Well, information asymmetry. It's the guys trying to sell the stock compared to what the market is going to know a month from now. Okay? It's not information asymmetry between the issuing firm and the stockholders buying the stock, or between the investment bank and the issuing firm. It's between the issuing firm and the investment bank and the aggregation of demand in the market a month later. So we were trying to ask this question, okay, model these forecast errors. What would be the right way to think about it? Well, the first thing you'll notice, after you notice the mean is big and the variance is big, is that it's also skewed. The little lighter colored histogram that's also shown here is what a normal distribution would look like if it had the same mean and variance as this histogram. And what you'll notice is, not too surprisingly, the actual histogram is much more spiked in the minus 20% to plus 20% range. But of course, if it's too high there, it must be, lower other places. Well, that's in the next range. And then there are far too many outliers. So there's lots of skewness, lots of outliers, all right, in this histogram. You might say to yourself, well, part of the problem with this is we're looking at 1 month returns. In a month, lots of stuff happens after the IPO and so forth. Although I have to say the reason we focused on 1 month returns here is to try and get rid of the price support process that sometimes happens after initial public offerings. If you go out a month, you're not going to have any price support left. So these are untainted market prices. But, if you looked at 1 day returns, you'd see basically the same thing. All right, the mean is 18%, the standard deviation is 40%. It's not quite as big as the 21-day return, but of course it shouldn't be, because the 21-day return has the 1-day return in it and 20 trading days, and if the variance of that isn't bigger than the 1-day variance, then we have some real serious mean reversion going on. But most of the variance is the first day, okay? And of course, the skewness is still there, so the picture is pretty much the same either way. What causes histograms that look like that? Well, one of the things that causes histograms that look like that is non-constant variance over time. This is what, you could think of this lecture as Rob Engel meets Jay Ritter, in the sense that Jay Ritter has, probably done more work on IPOs than anybody I know. And a lot of the data that people use to study IPOs is data that Jay's put together. And he's produced graphs that look a lot like this one, showing the bars along the bottom being the number of IPOs and the blue line being the average, the blue line, the solid blue line above that being the average underpricing across all deals within a particular calendar month. Okay? What Michelle and Mike and I added to this graph from what Jay and Roger Ibbotson had done earlier, besides more time series data, was we added the little red line. What's the little red line? The little red line measures the standard deviation of returns to IPOs across all deals that occur within a given calendar month. And so what you see in this graph is that the volatility, or the average level, and also the volatility of IPO returns changes over time. In particular, if you've got this period from the late 90s to the early 2000s in there, people sometimes refer to that as the dot-com bubble, whatever you want to call it. It definitely is a period of high IPO underpricing and really volatile underpricing. So what do you get from this? This graph basically tells the story that there have been hot and cold IPO markets. And hot and cold IPO markets basically can be described as lots of deals, lots of underpricing, lots of volatility. And those three things go together. So there's clearly a time series component to this problem too. So we thought, okay, how are we going to attack this? We've got time series phenomena going on here. Clearly, there are lots of papers that talk about how much more uncertain an IPO is for a firm that has no operating history compared to a firm that has been operating for a long time, firms in technology industries where you really have a hard time forecasting future value. There's a variety of variables people have identified as factors that make it harder or easier to value a particular public offering. We decided to try and take both time series and cross-sectional cuts at this in different ways. Here's a table of summary statistics which focus on the time series aspect of it. They're just like the graph we just looked at, okay, except it's a table of numbers. What do you see here? What you're looking at here are averages of average returns. So it's the average across the different months in the graph that we just looked at of the average return to all IPOs in the month. So that would be what the first row in this table represents. In this case, across the 456 months that had at least one IPO in them, the average monthly return was about 17%. Now you notice that's not the same thing as the average of all the deals, and that's because the average of all the deals, there's a cluster of months in the late 90s, early 2000s with very high average returns, but it's not very many months. Lots of deals, not very many months. And the last 6 columns show you the autocorrelations of those monthly returns. So you can, if you want to think about this as a portfolio strategy, it's like if you bought an equal amount of all the IPOs that came public in the month, this is the return to that portfolio. And these autocorrelations are quite large and positive. They don't decay very fast. What this says is if you're in a hot IPO market that has lots of underpricing, it'll probably stay hot for a while. If you're in a cold market, i.e. fairly low underpricing, it'll probably stay cold for a while. The second row in each of these panels measures the average of the standard deviation within the month, all right, for all IPOs in the month. The average standard deviation is about 30%, and you'll notice it's also autocorrelated, maybe even more so than the average return is. The most interesting thing, though, is if you look at about the 6th column, there's something called CORR. That tells you the correlation between the average return and the standard deviation across time. In other words, take all these average returns for every month, all these standard deviations for every month, and look at the correlation between them. They go up and down together. That correlation is 0.88. So just like you saw in the graph, the blue line and the red line move together strongly. Well, that shows up numerically too as an incredibly high co-movement. So markets where you have lots of underpricing on average are also markets where you have lots of dispersion of underpricing. which means, of course, if you've got a high average and a high dispersion, you can get some really big numbers out there in the tails of these. Okay. The rest of this table basically breaks up the 40-year period from 65 to 2005 into sub-periods. And what you more or less see is that the same general behavior happens in all the sub-periods. Average underpricing and volatility of underpricing move together. Okay. Why might some firms' deals be more underpriced than others? Or why might some firms' IPO prices be forecasted less accurately than others? Because it's both the average and the standard deviation we care about here. Now we want to turn the cross-sectional lens on this problem. What we're looking at here is really just, if you want to think of it this way, correlations. This is very much like a correlation between average initial returns in the first column, standard deviation of initial returns in the second column, and various deal and firm characteristics like the average underwriter rank. Now, if you're at all familiar with the IPO literature, underwriter rank is basically supposed to be a metric for the quality of the reputation of the underwriter. I think the best data currently available on underwriter rank are ones that Jay Ritter has on his webpage, and I believe that's what we used here. The intuition is if you've got Goldman Sachs underwriting your deal, you have an investment banker with a better reputation and sort of a more serious bonding capability than if you had your local fly-by-night investment bank that has never done a deal, but they're right down the street from you. And that's the idea there. Turns out underwriter rank doesn't do much for you, but in any case. Without going through each of the individual variables, probably the most important two are the last two. Firm age. And again, I think the best data on firm age is also on Jay's webpage. This is not an advertisement for Jay Ritter's webpage, but if you're interested in IPO data, it's the first place I'd look. The intuition here is that if you've got a firm that has a long operating history but just doesn't happen to have been public during all that period, people know a whole lot more about the firm than if the firm is truly a startup and has no operating revenue, for example. And so the ability to forecast what the value of the stock is when you sell it will be higher, better, if you will, for a firm with a long operating history. And sure enough, you find fairly strongly that underpricing is smaller and the volatility of underpricing is smaller when older firms are coming to the market than when it's mostly younger firms. There's one other statistic at the bottom that also measures, is a slightly different measure of this uncertainty or information asymmetry associated with the IPO pricing process. The average absolute price update, what is that? It's not true in every deal, but in most deals, the original red herring prospectus has a range of offering prices. And if you take the midpoint of that range as your first estimate of what the IPO price will be, and then compare that to what the IPO price turns out to be, when there's a big change between those two, that means that the investment bank and or the issuing firm learned a lot through the roadshow process, through the process of marketing the stock to prospective investors. And so they reduced some of their information asymmetry between themselves and the market as to what the final market price of the stock would be. Now, it's fairly well known that this forecast error, the price update, is correlated with the IPO return, which is another sort of puzzling question. Why investment banks and issuing firms move in the direction of market demand, but not all the way. But the fact is, this is a first indication of the fact that your forecast of what the IPO price is going to be was not very well informed when you first started out with the red herring prospectus. And sure enough, you find that large price updates are associated with more underpricing and with higher volatility of underpricing, which is, again, pretty much what I just said. All right, so those are simple correlations. In any cross-sectional study, before you start doing something fancy, you probably want to do something simple. This is the simple first step. It's not the last step. Okay, this is the more complicated next step. This is a page full of algebra. And you say to yourself, holy smoke, we went from a bunch of correlations to a bunch of Greek letters. Well, yes and no. The first equation, which spans 3 lines, is simply, if you want to think of it this way, the same kind of multiple regression that shows up in the IPO literature all over the place. That is, average initial returns are related to things like investment banker rank, the size of the offering measured in shares, whether it's a technology firm, whether it was a venture capital firm investing in the firm when it was private, whether it's going to be listed in the New York Stock Exchange or on NASDAQ, how old the firm is, and how big the price update is. I mean, that's kind of a laundry, you know, if you want a laundry list of things people put on the right-hand side, this is a representative laundry list. That's not interesting, well, I should say. That's plenty interesting, but it's not new, okay? That's what everybody does. Here's what we did that was a little different. If the idea is that this inability to forecast initial public returns to initial public offerings affects not only average underpricing, but even more importantly, the forecast error, the variance of your forecast of the IPO price. What we want to do is model the variance of the error from this mean equation, if you want to think of it this way, as a function of these same characteristics. So the second equation is like, when I said Rob Engel meets Jay Ritter, this is like Rob Engel. I'm going to think of the log of the variance of the error from the mean equation as being a linear function of exactly the same characteristics that explain the mean. All right? And then we're going to do weighted least squares. We're essentially going to find the maximum likelihood estimate of all of these parameters, the mean equation and the variance equation, assuming that the errors are normally distributed, but with a variance that's a function of these parameters. And so we, create the weights using equation 2 and then do weighted least squares on equation 1 and let the computer tell us what set of parameter values, betas and gammas, that maximize the likelihood function. All right, minimize the weighted sum of the weighted least squares sum. Same thing. So let me show you how that works out when we actually get estimates of this. No way you'll ever read these numbers. You can always, if you really want to see the numbers, go back and look at the Journal of Finance paper. But let me tell you what the numbers say. In a multiple regression, a lot of the things we have been talking about, show up in a sample of almost 7,000 observations. Not surprising, a lot of them are significant. Probably the biggest ones are the price update and firm age, technology dummy a little bit. The first column is essentially your normal cross-sectional regression mean equation explaining IPO underpricing. The R squared is 24%. It's fine. It is what it is, like it or not. Does it have potentially some of the kinds of dependency problems that Mitch Peterson writes about in his paper on how to calculate standard errors? Maybe. It's not quite the same thing because these IPOs, this is not a cross-sectional regression in the sense that all the IPOs happen in the same time period and we're just looking at them across firms, but it's cross-sectional in the sense that every firm only has one IPO. almost by definition. So, you know, it is what it is. The log likelihood for that regression is minus 4,700. You say to yourself, well, why? You know, nobody ever talks about log likelihoods. Well, most people don't. And I wouldn't either, except for what I'm going to do next. The next two columns, under the label MLE, are essentially weighted least squares, where what we've done is estimate the mean equation. It's the same thing that's in the first column labeled OLS. Estimate the mean equation, but weighting the errors in the mean equation by our estimates of the standard deviation of those errors. And where do we get those from? We get those from the far right-hand column, which is the model for the variance, which I showed you just a minute ago, again, is literally a linear function modeling the log of the variance, is a linear function of the same variables that are in the mean equation. Now, what do you see from this? You see that most of the things that are important in explaining underpricing are even more important in explaining the variability of underpricing. So your uncertainty about being able to forecast what the aftermarket price of a stock is following an initial public offering is even more closely tied to these firm and deal characteristics than your ability to forecast whether the mean, or the actual return, is right or not. And they go in the same direction. The same things that cause information asymmetry, if you will, technology dummy, firm age, and so on and so forth, affect the variance even more than they affect the mean. Is this a better model? Well, if you look at the log likelihood under the weighted least squares column, if you want to think of it that way, it's minus 1,800 compared to minus 4,700. How many people remember your graduate econometrics course where, somebody told you that minus 2 times the log likelihood function was a chi-square test, a large sample chi-square test? Well, you don't have to, this is simple. There's about, 10 parameters there. The difference in the log likelihoods is 3,000. That's a chi-square with 10 degrees of freedom. That's pretty significant. This is a huge improvement. Now, intuitively, what's going on here? Well, intuitively, if you go back and look at the graph here of the time series of standard deviations, you see that they're all over the place. And so by down-weighting the periods where you have the highest variance, you get a much better, more efficient estimate of the model. That's what weighted least squares is all about. If there wasn't variation in the standard deviations, in the variances, there. If equation 2 wasn't helping you, all right, then weighted least squares and ordinary least squares would give you more or less the same answer. And they're not even close. Well, they're close in the sense they give you the same qualitative information, but statistically they're not even close. The weighted least squares / MLE is tons better than just running the cross-sectional regression. Moreover, at least from our point of view, the thing we were most interested in was the lack of forecasting ability. That is, how big is the variance of the error? And here, the right-hand column is not just providing a useful, social service to give us weights to do weighted least squares. It's actually an object we care about directly. What are the things that are associated with investment bankers having such a hard time doing this work? Okay, now that's the good news. The bad news is, up to this point in that previous table, it's all cross-sectional. That is, the only thing we're looking at are deal and firm characteristics. Go back to this graph, if what was driving the time series movements we're seeing here was that different types of firms with different characteristics happened to come to the market, all right, at different points in time, so that all those young, risky tech firms were the ones that came to the market in the late 90s, early 2000s, and for the rest of the time period, it was old, mature, private firms that had been around for hundreds of years. Then maybe the difference in cross-sectional variation could explain these time series pictures. But I'll tell you right away, that's not going to work. I mean, that'll help a little, but that's only part of the story. So the next thing we did was say to ourselves, okay, now let's think time series. And that of course, was the theme of this lecture, supposedly, so we're finally getting to time series. Now let's think time series. How do we deal with time series here? Well, the IPOs happen at different points in time, but most people, when they think time series, they think about repeated observations on the same variable. Gross domestic product growth, a year ago, 6 months ago, last quarter, whatever. But the same variable measured at different points in time. We don't have the same variable measured at different points in time, or do we? Well, this is where I want you to take a leap of faith with me. We decided to pretend we were observing repeated observations of the same variable at different points in time. We were going to treat each of these initial public offering returns, which of course are for 8,000 different firms, but happen at different points in time, as if they were the output of a time series process. So, IPO number 1 happens first, IPO number 2 happens second, and so on and so forth. Think of that as if it's a drawing from a stationary stochastic process, a time series. And now we're going to measure that and model it. How do we model it? Well, I come from a history where Charles Nelson was also one of the people I worked with, Arnold Zellner too. And Charles had his graduate education at Wisconsin, and George Box was there. So one of the things he taught me, and he taught a lot of people, was that Box-Jenkins ARIMA models were a useful way to model time series behavior in what would essentially be the mean equation. So for lack of better imagination, we decided to take the mean equation model we already had and add to it an ARMA 1-1 model. That is, one autoregressive term, one moving average term. Okay, what does that mean? That means the shock to IPO number 1500 is related to the shock to IPO number 1499, and also 1498, 1497, and so on and so forth. And when we're talking about the shocks here, that is the part of the mean equation that's not explained by firm characteristics and deal characteristics. So how could you rationalize something like this happening? Well, if it's a byproduct of market conditions, hot and not cold IPO markets, whether you think of those as being supply-driven or demand-driven, in some reduced form, it appears as though sometimes the dentists anybody from Des Moines here? Okay. The dentists in Des Moines get really enthusiastic about buying IPOs, and they just want to pay any price they can to get one. And sometimes they've got burned and they decide not to buy any. And I'm picking on dentists from Des Moines as being uninformed investors. They could be incredibly informed. But it's something I say, and I apologize in advance to anybody who's from Des Moines or is a dentist, or knows anybody who's a dentist from Des Moines. The idea being that somehow, the pricing of recent IPOs helps you predict how IPOs, at least in the near future, are likely to occur as well. All right, so let's see how that works. Basically what that amounts to is same mean equation, except we have this ARMA 1-1 process for the error. That's that last line. When we estimate this model, it turns out that we find, using the same basic technique we've been doing so far, that is, we're going to do weighted least squares. It's really maximum likelihood. The only thing we've done up to this point is add the ARMA 1-1 part to the mean equation, which essentially puts a time series component into the mean equation. The estimate of the autoregressive parameter is 0.95. The estimate of the moving average parameter is 0.9. They're not exactly the same. this exactly predicts slow-moving positive autocorrelations that persist for a very long time. If you, again, treating this as a time series process, calculated autocorrelations of the residuals, okay, and again, that only, autocorrelations of the residuals only make sense if there's some time ordering of them. You wouldn't calculate autocorrelations from a cross-sectional regression, right? Not unless you ordered the data somehow in the sample as a function of something. But in this case, we're ordering it as a function of time. The autocorrelations of the residuals from the prior equation, the one that just had the cross-sectional stuff in it, had a Young, I think that's how it's pronounced, box statistic for 20 lags of the autocorrelations of 2,850. Now, that's supposed to be chi-squared distributed with 20 degrees of freedom. Since this is an econometrics tutorial, what is the mean of a chi-square with 20 degrees of freedom? I'll give you a hint. I said the number a minute ago. It's the degrees of freedom. It's 20. And what's the variance of a chi-square with 20 degrees of freedom? See, this is a tutorial. I heard it, but somebody say it again. 40. 2 times the degrees of freedom. What's the standard deviation? What's the square root of 40? That's easy. So, and roughly speaking, for 40 degrees of freedom, you could take 2 standard errors plus the mean, which would be, 20 plus maybe 13, and that would give you a cutoff for an upper bound 5% test. So imagine, the critical value for whether this chi-square statistic would be significant is something like 35, 40, and it's 2,800. Is that significant? Oh, yeah. It means there's lots and lots of autocorrelation there. All right? Just putting the ARMA 1.1 model into this takes that down to 129. Now, those of you who are purists are going to say, well, wait a minute, 129 is still too big. Yeah, fine, but it's a whole lot better than 2,800. All right? So by treating this kind of oddball sample as a time series, we have managed to fix a lot of the correlation that's in the errors in that cross-sectional regression we were running before, estimating before, just by doing a relatively straightforward time series treatment of it. And it improves the statistical properties of the model a lot. But I don't know, when I started this talk, I said this talk is going to be Rob Engel meets Jay Ritter, right? Rob Engel won the Nobel Prize in Economics, not for ARMA models. He didn't invent ARMA models. That was Box and Jenkins. They didn't invent them either, for that matter, but they popularized them. What did Rob Engel invent? Yeah, arch, garch, e-garch, put in your favorite letter, arch. I don't have a blackboard, so I can't do it. The first time I ever ran into Rob in the context of time-varying volatility, I was out at a conference he was hosting at San Diego, and I was presenting an earlier version of a paper that Ken French and Rob Stambaugh and I later published in the JFE. And in that version of the paper, there were no arch models in it. There was an arch model in the final published version of the paper, but the version I presented at this conference, there wasn't. And the discussant I had, who, to be honest, I don't remember who it was at this point, so he's off the hook, but he was really cute. He walked up and wrote on the blackboard that this paper was about, and he wrote the letter B, the number 4, and then ARCH. And you say, because one of the things that was true about this conference is it was Rob and all the students. And what that meant was all of them had their own flavor of arch models. Well, the flavor we had was the B4 arch flavor, which I think was meant to be condescending, but in any case, it was humorous. the point is, what did Rob Engel do? He basically came up with the idea of modeling time-varying volatility using techniques very similar to what I already was describing to you. It's essentially weighted least squares. All right? But it's weighted least squares using what amounts to like an ARMA model for the variances. Okay? And so we want to do that here too. Just like we had an ARMA model for the mean equation, we're going to have an EGARCH model. EGARCH. Exponential, generalized, autoregressive, conditional, heteroscedasticity. Now you know why they call it EGARCH. We're going to have an EGARCH model for the variance, which allows for both cross-sectional changes in uncertainty about IPO pricing, as well as time series changes. And I want to be upfront, this was exactly suggested to me by Rob Engel when he saw an earlier version of this paper. We were doing just the time series version of this, and he said, Bill, you can do even better. You can have a cross-sectional component and a time series component. And here's how you do it. You treat the cross-sectional model just like we've been doing, okay? The EGARCH model is a different factor. Instead of sigma squared parentheses epsilon, it's just sigma squared t, okay? And that's set up to look more or less like an ARMA 1-1 in the sense that you have last period's log of volatility and an innovation that's a function of the square of the mean equation, error. That's sort of like the AR, or the MA term. But the key here is, in order to be able to have both cross-sectional and time series characteristics in here, without having the cross-sectional characteristics from this deal be related to the cross-sectional characteristics of the next deal, which may look nothing like it. You know, first you got an old firm, then you got a new firm. You don't, if you just plug those into a GARCH model, you're going to have the lag-dependent variable problem. But if you break it up into components, that is, treat the cross-sectional component separately from the time series component, and view the variance of the error term from the mean equation as the product of those two things, then you don't end up with this sort of lag-dependent variable problem. And it's kind of a cute outcome. So we did that. When we did that, the arch coefficient, which is typically a really small number, was a really small number. And the GARCH coefficient, which is sort of like an autoregressive parameter in an ARMA model, was huge, 0.984, which is very consistent with what you get in most treatments of things like daily market returns. If you have looked at one of the applications of GARCH models to measuring time period volatility for returns to something like the S&P 500 index. And so this behavior is pretty much exactly what you'd expect to see from a normal old run-of-the-mill capital markets GARCH model with daily data, for example. Lots of persistence in the time characteristic of volatility. When you add this component to the model, so you have both an ARMA model in the mean equation and an EGARCH model in the variance equation, in addition to all that cross-sectional stuff we had going on. The Lung box statistic for the autocorrelations of IPO returns is now down to 57. It was 127 a minute ago. Got it down to 57. And the same thing, Lung box autocorrelations for the squared residuals, which is a diagnostic for whether you fix the conditional heteroscedasticity problem, drops to 67. It had been 317 from the ARMA model. So you kind of fixed, actually not kind of, you did a pretty good job of fixing the time variation in the volatility of both mean returns, the behavior of mean returns, and the volatility of IPO returns as well. Now, what you end up with is a really complicated model. If you go look at the the published paper, or the table for this, is about 2 pages long because there's lots and lots of parameters there. But it fits the data really, really well. Now, why is that a good thing? Well, you're getting back to my analogy to Mitch Peterson's paper on, how to calculate standard errors, when you have using clustering, when you have cross-sectional regressions in finance. What we're doing here is trying to get as much as we can of the dependence that's in the data modeled in the model, so the errors, from the final model we've got, the ARMA model, the eGarch model, are in fact random shocks. And they're random shocks that have the same variability. So the inferences we want to draw about what you learn about IPO pricing turn out to be much better than they would be if you just ran the cross-sectional regression model and ignored the fact you had all this dependence in the data, both time series and cross-sectional and heteroscedasticity. So from a econometric modeling point of view, being willing to take the heroic jump of saying, we're going to treat this as a time series, even though it doesn't look like, the kind of time series that you normally think about. They're not equally spaced observations. In fact, there are some cases where multiple IPOs happen on a given day. How do you deal with those? You just randomly assume one came before the other and suck it up, or whatever. There are probably lots of things you could do. I don't think it would make any difference. But you can also go for months with no IPO. And we treat those as if they're realizations of a stationary stochastic process. That is, repeated draws from the same urn. It works pretty well. We actually tried tricks like how much time has passed since the last IPO, because you might think even if it doesn't affect the mean return, it might affect the variability of it. It doesn't. It's more or less the length of time since the last deal doesn't seem to be a factor that matters, although it could. It turned out it didn't. So what did we learn from all this? Well, we learned that this information asymmetry story, aka it's really hard to figure out what price to put on IPO, is really true. And in some sense, the modeling or the analysis of the variability of these forecast errors, I think gives you more insight into it than knowing that the average is a big number. Knowing the average is a big number is interesting, but it's not the whole story at all. If you go look at that paper, you'll find that we sort of turned this conclusion into a sort of a musing section of the paper. Wouldn't it be better if there were alternative ways to set these prices that weren't so prone to forecast error? And of course, the most obvious one of those that's available that people have actually tried to use is to have an IPO auction. And it turns out if you look at the handful of IPO auctions in the context of the analysis we've done here, not too surprisingly, IPO auctions have less underpricing on average and a lot less variability. All right. Now, the other thing you certainly know about IPO auctions is there aren't very many of them, and that's kind of an interesting puzzle too. And obviously, a lecture on time series econometrics isn't going to answer that question. But I point you to the paper for that part of the story. So, what would I like you to come away from this with? I think it's worth thinking more broadly about the role that uncertainty plays, not just in capital markets, asset pricing papers, but in corporate finance contexts too. I mean, this problem of how do we set the price for an IPO when we don't have, we can't look in the Wall Street Journal and see what the price was yesterday. Seasoned equity offerings, it's not so hard, all right? But initial public offerings, it's a hard exercise. And there are plenty of other things where CFOs, investment bankers, and whatnot have a hard time knowing exactly what it is they're going to be dealing with. the uncertainty associated with that can sometimes be more important than, small average biases in the way things are done. I've often asked my MBA students when I talk about initial public offerings, how many of them, all of them have done valuations of one sort or another. And I'll ask the same question of you. Would you rather do a valuation of a private company or a public company? You have a choice. Private, all hands up. Everybody would rather do a valuation of a public company. How many people would rather do a valuation of a public company? You have to do one. Okay, I'd rather do the private company. Why is that? It's not nearly so embarrassing. All right. With the public company, Section C of the Wall Street Journal, comes out every morning, and unless the way you do the valuation is you look in Section C of the Wall Street Journal and have shares outstanding and multiply shares by price, your valuation analysis is going to have this problem that you probably aren't going to come up with the number that's in Section C of the Wall Street Journal. If you're valuing a private company, it's much easier. There's no Section C of the Wall Street Journal to embarrass you, right? But the basic, that's supposed to be funny. The basic point of all this is there are plenty of things we do and we teach and people do as practitioners that really involve a lot of guesswork. You can call it forecasting, whatever. Modeling the uncertainty associated with the guesswork, forecasting, whatever, it seems to me is a fertile area to move econometric techniques into the future. And I think formulating hypotheses or taking hypotheses about that uncertainty and then analyzing them in ways similar to this is a natural route for people to expand their research horizons if you're interested in both econometrics and finance. It's also a natural complement to, as I say, Mitch Peterson's suggestion that people be more careful in the way they calculate standard errors doing cross-section analysis. That's really what I wanted to say. I'd be glad to take questions if anybody has any. Yes?
Yeah, in this one, it's interesting how you modeled some based on noise. How do I capture that noise the most effective way, systematic way?
Yes.
Without providing much intuition, what's the source of this noise?
What's the source of the noise?
Yes. We can have, because there's no explicit analysis of it, finance it does our purpose. Now, in corporate finance, many times we see that most of the modeling economic treatments are done as if the corporation is operating in sort of a vacuum. It is an entity, there is no macroeconomic environment within which it is operating. So the macro factors which may generate the noise, they show up. Now the question I have specifically is that, are we better off going ahead and trying to model the error curve or look for factors so that we can say that this factor is driving this noise?
Okay, I promised the videographer I would try and repeat questions so that she would be able to have a record of it. I confess I would have a hard time with that one. I think what you're asking is, do you want to try and explain things that are explainable by putting more variables in the mean equation, right? Always that's true, okay? I would never say otherwise. But inherently, there are some things for which you just don't know the answer. I mean, in the IPO pricing problem, you have an issuing firm. I mean, think about the problem you've got. You've got a private firm, and you're trying to figure out what price per share to sell. Assume you've figured out how many shares you want to sell, because obviously, if price per share doesn't mean anything unless you figured out how many shares you want to sell. But suppose you're going to sell 20% of the firm, and you're going to sell 1 million shares. All right. Now, what price is that worth? Well, that's the same thing as asking, apart from control issues, what's the firm worth, right? And just like I said, I'd rather value a private firm. I'd rather value a private firm that wasn't about to go public because you can see my forecast here if I value the firm that's about to go public, because once it's public, it'll then trade, okay? I think what we're seeing here is even the most expert investment bankers who we have the nicest suits, okay, and I have nothing against investment bankers, but really don't have a clue what they're doing. They may be better than you and I, but fundamentally they're shooting in the dark. Now, when I first started giving this paper in audiences, I would have people like Kent Womack stand up and say, well, I worked in an investment bank, and certainly after we did the roadshow, we knew which deals were hot. We had indications of interest for 10 million shares when they were only going to sell 1 million. So we knew the price was going to go up. Well, yeah, you know what direction it's going to go, but the only answer you have when you've done indications of interest is how many shares will you buy at this price? You don't ask how many would you buy at this price. You don't ask for a demand curve. You ask for, a price. If it was 20, how many shares would you buy? And of course, the answers you get from that aren't actually, they're just literally indications of interest. They're not orders. So the forecasting problem of how do I go from the information I've collected to a forecast of what the aftermarket price is really going to be is very difficult. I mean, even I could probably figure out, well, we underpriced that one, okay? But by how much? Is it by 100%, 200%, by 20%? There's a big difference between 100% and 20%. And so, that's a particularly apt example because it's real easy to see it and there's lots of newspaper coverage of it. There's plenty of things that we do that aren't covered so much by newspapers that are just as equally difficult to really do. And I think it's worth, thinking about that. I mean, if you were in a merger negotiation, you're trying to decide what premium to offer. Well, no more than you absolutely have to, right? If you're the bidder, as much as possible if you're the target. But how do you come to a resolution of that? Most of the literature treats that as a two-person bargaining game, independent of the market. Well, that's not so clear to me. It's not at all clear to me that the people sitting in the room have the best knowledge of the value of the firm after it's merged, for example. So that there's lots and lots and lots of things that corporations do all the time that involve forecasts of value or a variety of other things where, they could be off by quite a bit. And the more uncertain they are, the more that's going to affect their behavior in bargaining or price setting or whatever. So I think that's the spirit of my comment. Yes.
So you mentioned the underwriter and you mentioned auction in this literature. Before Civil War, many firms actually go to public without an underwriter. So do you think that's interesting to explore more historical data for two reasons? The first one is it can rule out some theory. Because, for example, lots of things are based on agency theories, information asymmetry between the underwriter or underwriter need to have some kind of price support. And the second thing is it will increase the sample size in this literature because IPO usually have extremely limited observations.
Okay. 0 for 2. I'll have a really, I'm not quite sure what you asked. Let me try, okay, and it may not answer your question. Just like the SEC has started letting certain firms who have securities sold in secondary trading markets do things differently now than they used to do, quicker methods of selling seasoned equity offerings and so forth. My guess is that when Microsoft went public, they probably didn't need all the services that Goldman Sachs would provide to a company that wasn't well known already. in the same way that, you know, companies that are not so well known at the time they go public do need those kinds of services. So there's undoubtedly heterogeneity in sort of the demand for investment banking services. And, you know, setting the price is not the only service. I mean, there's lots of other services they provide too. I'm here just focusing on the price setting part. So I'm not advertising this is the answer to all questions in IPO, the IPO literature, but I think it is relevant to at least the price setting part of it. So, did I mischaracterize your question?
It was a part of it.
Okay.
Actually, basically, let me try to rephrase it.
Okay.
So, before Civil War, there's no underwriter. Many firms went public without underwriter.
Yes.
So IPO underpricing is the long literature, lots of explanations actually based on underwriting.
Right.
Either they price all or there's some kind of provision problems. My question is, like, suppose I can collect previous cohorts, like the IPO sample before the Civil War. I mean, do you think that's interesting? First of all, I think
maybe. I mean, you'd have to. I mean, I guess I'd have to know more about. It's hard to. I mean, how could I say that new information isn't valuable? I'm talking to a room of academics, I hope. You know, collecting a different sample that people haven't looked at and trying to learn something from it, I think is a great thing to do. Will it answer these kinds of questions? I don't know. It depends on, you know, the extent to which the sample you collect is informative about questions that are relevant now. So I don't know. I guess I really don't know how to answer your question. We didn't have the Securities and Exchange Commission prior to 1933. That's true. And there's a lot of regulation and standardization of securities offerings practices that are caused by the existence of federal regulations, although there were state regulations before that. So it's not like they were, totally unregulated. But I guess I'd have to know what the question is and what the sample was to be able to know how informative it would be. Yes?
Your main reasons on volume. I think the error term by definition.
Can you speak up?
By definition is what cannot be spent by.
Yes.
Variables, right?
Yes, correct.
And when you request I guess the variance cannot be split by these variables.
No, the variance can be.
Well, if you can't capture the meaning of the variance, then
Can't capture the what?
I just have a hard time to think that independent variables can capture the variance of error term. And when you request an error term, you can still get significant results.
No. It's the square of the error term. If you, okay, I'm going to give you, this is a statistics tutorial. All right. If the error is really normally distributed, the estimate of the sample mean and the estimate of the sample standard deviation are independent of each other. So the fact that the mean is unpredictable doesn't mean the variance is unpredictable. That's what Garch models are. The variance is predictable. I mean, in that case, from time series characteristics, but there's absolutely nothing wrong. I mean, let me put it to you a slightly different way. It doesn't make any sense to talk about a Garch model unless the error whose variance you're modeling is white noise. Okay, is random. If the error that you're measuring the variance of has predictable components to it, then you've got to get rid of those first before you can start modeling the variance. Go home and think about it. It's okay. It's a perfectly, I understand your intuition, but it just happens to be wrong. It's okay. And that's why it's called a tutorial. Questions? Yes.
What's the correlation between the mean and the standard deviation that you find?
Yeah.
I'm thinking that intuitively it's probably related to the skewness that you also show.
No. See, I understand what you're saying. I think it's the other way around. I think the skewness that we saw earlier is caused by the positive correlation of the mean and the standard deviation. So you wouldn't get, if it was just unconditional skewness, whoops, went too far. If it was just unconditional skewness, right, you wouldn't get this kind of behavior. That is the mean and the standard deviation moving up and down together, all right? Just skewness wouldn't give you this behavior, but this behavior will give you skewness. So they're definitely related, but I'd like to think that the evidence we have here shows that causality for the relation is the other way around. That is, it's the co-movement of the mean and the standard deviation that gives you the skewness in the unconditional histogram.
My question was going to be, once you know that, we know that in this distribution, right, the three moments, we know information about them. Does that mean that we should model the three of them? Or?
No, because, look, let me take a step back. Forget the skewness for the moment. Imagine there was no correlation between the time varying. Imagine we were simply talking about stock returns, so there's nothing predictable in them at all. And I'm now going to move away from time varying expected returns. Just assume that stock returns are, independently but not identically distributed through time. And the variance changes. What happens to the histogram? Well, the histogram doesn't look normal anymore. It looks fat-tailed. If you remember the early literature that my thesis advisor, Gene Fama, was a big contributor to about fat-tailed distributions, I would be willing to bet, and he might, but not, but I would be willing to bet 95% of the evidence for fat-tailed distributions comes from time-varying volatility. All right, the unconditional histograms look fat-tailed, but that's because that's exactly what you get when you draw a histogram from a mixture of distributions with different variances. And we have lots of evidence, direct evidence from Garch models and other places, that there are predictable movements in variances. It's not random changes in variance, it's predictable movements in variance. And so it's the same thing here. What we're getting here is fat tails, but skewness. And what causes the skewness? Well, what causes the skewness is there is a relation between the mean return and the variance. That is, they move up and down together, and that's exactly what generates the skewness in the unconditional distribution. So you should think of this as a symptom, not a cause. At least that's the way I would like you to think about it. Yes. And let me just interrupt for a second. That was a great question because I meant to talk about that and I forgot to. So go ahead. I'm sorry.
Why don't you use realized volatility instead of time varying expected?
What do you mean realized volatility?
It's using high frequency data.
Yeah, but for what? See, this is the trick here. The trick is we're treating these initial public offering returns as if they're realizations from one stochastic process. What you're talking about is, secondary market trading activity. Take the variance of returns every 5 minutes within the day to the S&P index. Realized volatility is something I invented. Even George Tauchen admits that. And I like it, but it's not relevant here because there's no other observation on the IPO return of Microsoft. We only get one observation of that. That's one of the 8,000 observations. So there's nothing to measure realized volatility with. No. We have, in here, just as a diagnostic device, what we did was calculate the standard deviation across deals that happened in the same calendar month. Okay, but this is, think of this as sort of a diagnostic way to learn about the fact that there is something funny going on in the time series. But there's no analog to realized volatility here. I think you're kind of forced to do something like what we're doing. Yes. Yes.
I was
Yes. And by the way, you get that even in the one-day return.
Right. And
Some of those are big numbers.
I suspect they did underpricing intentionally.
Oh, no, wait a minute. Let me be clear. I'm willing to believe, for all the theoretical reasons in the IPO literature, that investment banks and firms issuing their stock intentionally underprice their stock 10%.
Are you intentionally underpriced?
No, 10%. I might even give you 15%. But I'm not going to give you 200%, and I'm definitely not going to give you 200% for one deal and minus 20% for the other. Okay? I mean, the average number isn't so, I mean, it's kind of big, but it's not so appalling. All right? I mean, you can tell lots of stories about why it might make sense. I mean, the story that firms want to entice institutional investors to make the investment, to learn about their company, you know, blah, 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 blah. And the payoff for that is we'll give them a bargain by letting them buy the stock in the allocation of the IPO at a price that we know is a little too low. That's okay. I mean, that's a story I perfectly believe. But 10%, not 200%. So,
But it's kind of hard to believe that all those 8,700 observations come from one series, and those
well, I don't know. I mean, it depends. I mean, my argument is they aren't, right? Because we have a cross-sectional model that explains some of the differences in means and differences in variances. So it's not, in that sense, it's not one model in the sense that there's a urn that I pull the numbers out of and it's IID normal. I agree with you. I mean, you and I are in complete agreement. That was the whole point of everything after this. Okay. I think are we close to done?
I just want to thank Bill for sharing this paper and these insights with us. I think it's given us a lot to think about. I want to thank you for joining us this afternoon. Enjoy the rest of